I'm Anthony Valeri, Director of Investment Management in Wealth and Fiduciary Services. Thank you for joining. Today, we'll take a look at what the Fed's first interest rate hike since 2018 may mean for stock and bond markets going forward. We'll start with a look at the 2-year Treasury yield to get an indication of what short-term interest rates might do. And here we take a look back at all of the Fed's rate hike campaigns going back to the early 90s. We stop at the early 90s because monetary policy has been run the same since the early 90s, and we felt it representative of the current environment. And as you can see here, the 2-year Treasury yield in the months leading up to the Fed's first rate hike has increased, sometimes more than others, and 2022 showing a substantial increase. But what you find after the Fed's first rate hike is that those short-term yields continue to move higher. So although rates have come up a lot in terms of short-term bonds, we're likely to see even higher short-term rates. Let's move to the 10-year. And similar situation here. As we look back at prior rate hike campaigns, the 10-year Treasury yield increased heading into the Fed's first rate hike. However, the results after that rate hike are a little different. A mixed result here. In two of the occasions, the 10-year Treasury yield continued to increase, particularly in 1994 in response to an aggressive Fed rate hike campaign. But in two of those occurrences, the 10-year Treasury yield actually came down. And that's because investors began to worry about the Fed raising interest rates as the economy was going to slow. That might be the case again here, given the recent increase. So whether the 10-year Treasury yield continues to rise, stays flat, or comes down, depends on the market's view of the economy and inflation. So a more mixed result on the 10-year Treasury. Now let's look at the yield curve. Historically, one of the best indicators of a recession and often gets a lot of attention as the Fed raises interest rates. Now here we look at the yield curve as measured by the yield differential between the 10 and 2-year Treasury. The narrower that yield advantage, the flatter a yield curve is, and the wider that difference is, the steeper the yield curve is. And you can see in all occasions, the yield curve is generally flattened leading into the Fed's first rate hike. And then after that Fed rate hike, the yield curve continued to flatten or remain very flat. Now the market in the current environment has flattened quite a bit already. It's a sign that the bond market's worried about the Fed raising rates too aggressively in response to rising inflation and an economy that will slow on its own. So this needs to be watched because in 1999, the yield curve went negative or inverted, signaling a recession, which ultimately occurred. So we do have to keep a close eye on this metric to see whether it continues to flatten and send a sign to the Fed to be more cautious. Now let's wrap it up with a look at the stock market around the Fed's first rate hike. Here we index stock market performance to 100 right at the time of the Fed's first rate hike. And you can see results for the stock market performance heading into the Fed's first rate hike are mixed. In some cases it rose, some cases it was volatile, up and down. And in 2022, the stock market has certainly declined ahead of this interest rate hike, March 16th. Most important to note here, in the first 2 months after that Fed rate hike, in all cases, stocks traded lower. So although the stock market was higher on this new rate hike campaign, we can expect, if history is any guide, some additional volatility over the coming months as investors debate how far and how quickly the Fed will take short-term interest rates. Another takeaway from this chart is to show that over the longer term, however, and in all 4 previous cases since 1990, stocks did ultimately move higher after that first interest rate hike. So yet another reminder not to abandon a long-term investment program. I'm Anthony Valeri. Thanks very much for joining, and talk to you again soon.